in a market sometimes can leave you speechless. And this one stock which is, I think, leaving everybody speechless. 20% higher for Barbecue Nation. Manish Sonthalia, good morning. Thank you for joining us. What is your market view, Manish? Are we in for a pause? Are we in for a retreat, or this market will continue to climb the wall of worry?
No, so I think that, volatility will be there, but the direction of the markets are clearly on the upside. And it's a buy on dips market. This on the back of very strong earnings expectation for Q4, whole of FY22, and even extending into FY23. The confidence comes in with vaccination now in full swing. Of course, we are fearing a second wave right now. But I think that could be temporary. You could see a spike for a month or two in the number of COVID cases. But otherwise, the economy is reviving, very well. And I think it's likely to continue. According to me, it's a bullish market even now.
I haven't spoken to you in a while, Manish. So let's talk about what kind of big changes you've done in the portfolios you manage. The first recall of Motilal Oswal AMC and the funds which Manish manages is iShare, Maruti, HDFC Life, HDFC Bank. Have you changed your orientation given that the current orientation of the market is tilted towards cyclicals and industrials?
Yeah, so, we have been very overweight on the consumer space as a whole for many, many years now. And within that space, given that it's going to be a very strong economy recovery, the TINA factor which applied to the consumer space, particularly the staple space, all these years, you got the market cap increase in the stocks, irrespective of whether earnings came through or P multiple expanded. I don't think that thing can continue now with a full-blown economy recovery. You will see a rotation trade. So basically, the cyclical sectors, the sectors which are very strongly correlated to the economy, are going to do much better. Funds will move out of staples, which have given very healthy returns. They could be in for some time consolidation given the valuation. In that aspect, we have reduced our allocations to the consumer space where we were extremely overweight. The staple space, and now we have moved it down to an equal weight position. On the other hand, because consumers are likely to spend more on discretionary items, we have overweighted on consumer discretionary names, and this would include automobiles. On the industrial side, we have again gone overweight. As I said, that we expect a full-blown economy recovery. The budget had allocations for capital formation, which had been missing in India over the last 10 years, ever since the global financial crisis. I think it's high time, and the full-blown impact of this is going to be seen within, let's say, next 4 to 6 quarters. But this is definitely one trade which, according to me, would likely play out favorably. So we are trying to get a foothold into some of the industrial names. We are positive on this sector. So these are some of the sector changes that we have made. In terms of stocks that we have bought very recently is Gland Pharma on the day of the listing, where we think it's a high quality injectables player. And 20 to 25% growth visibility in this name over the next 3 years at least is very much very, very high. So, and valuations from, let's say, next 3 to 5 years looks pretty conducive. So that's one bottom-up stock that we have included in the portfolio. And the second is State Bank of India, where we clearly think that the entire focus will be on large cap banks, both private and PSUs. Of course, in the PSU space, it's only to choose in SBI, nothing else. Given that Q3 numbers were simply too good, the asset quality, the growth, the provisions, and the valuation, roughly 1.1 times price to book. So these are the two stocks that we included. In terms of what went out of the portfolio, of course, Medcap banks, so City Union Bank was sold, and we also trimmed down some allocations and rebalanced the portfolio on the whole.
Okay, we always tend to focus on what to buy, but to make space to buy Gland Pharma and State Bank of India, you must have taken some chips off the table. When you say you've sold out of consumer stocks, are you finally moving out of your consumer, of your comfort zone, which is Nestle and Asian Paints? I mean, Manish Sonthalia, I thought would never sell Asian Paints and Nestle.
No, so it's a rebalancing on the portfolio, not that, we have exited many of the names fully, but, taken some allocations off the table in the consumer staple names. Specifically, let's say we have taken allocation of Page Industries, which has been long there in the portfolio. It has been a big winner. But it's time to make room for some high quality injectables players. I mean, valuations, etc. are very conducive. So that went out. Mid-cap banks is clearly to be out of focus when it comes to banking over the next 5-10 years, be the technology capability or regional presence, or the capital buffer, the growth for the next 2 years, provisioning. All of these things are worrisome points for the mid-cap banking space. So we have taken allocation of that sector as a whole. So some trimmings here and there has given way to buy new stocks in the portfolio.
Sure. On the debate about value versus growth, Manish, you've always said that for value, only buy deep value. Where is it that you're finding this deep value? As I understand, PSUs are something where you find value right now. Why is that?
Yes, so the idea is to have a barbell strategy. Basically growth works, and that's proven. But there's one segment of the market, and you rightly said the public sector undertakings, where I think there is deep value. And so these deep values also can't sustain for very long. So some of the monopolies in the PSU space are still trading at ridiculous valuations. So you take the well marketing and refining companies, or you take the container corporations of the world, or some of the material names in the PSU space, dividend yields in excess of 5, 7, 10%, and P multiples in single digits. Again, that looks to be on the extreme side. So it is good that one should have majority of the stocks that growth stocks in the portfolio, but there should be some room for including deep value stocks. That's how I would look at it. And I have some of these names, the deep value names, which I reckon could have some decent upside in the portfolio.
Okay. Aside of PSUs, where else do you find value in the market right now, Manish?
So again, if there is to be value, it has to be looked at in conjunction to growth. So obviously, you're going to see some hyper growth in the fourth quarter and the FY22 as a whole, thanks to a small base. But what may not be fully factored in is the growth for technology names. You don't have atrocious valuations on technology names. Of course, they are at multi-year highs, but the way things are playing out, and the digital transformation or the cloud migration spend that's likely to be there, at least for the next 2 years, can continue into the next 3-5 years as well. Whether all of that is there in the price, I would not think so. And so there is one area of value in the technology names, given the growth that could emerge. You could see stocks even doubling from these levels over the next 3-4 years. That is one area where I think there is some very decent value on the table, which has not yet been fully factored in by them.
Okay, interesting. Would that also, if we were to go deeper into that as well, and on tech, Manish, share with us a little bit more in terms of how you're trying to slice and dice and find those plays, and whether or not the same rationale also applies to some of the pharma names on the back of factors like the export market, IT knowledge, technical knowledge, and so forth.
So the biggest value driver in the technology space would be your digital transformation, cloud migration. It's now become almost impossible for any company to not have digital capabilities, to not move their core businesses onto the cloud. I mean, these companies are going to get left behind in a big way. So that is one area, and companies which are where the share of the digital piece versus the legacy piece skews in favor of the digital piece, there you would see higher than the industry growth rates. If they are able to have these transformations, you could see some margin augmentation from them going into the future. Of course, this is going to also help the IT companies because billing rates are slightly to inch up, maybe $1 or $2 is in the next 2 years. All of that, if it is there in the market, understood by the market, I don't think so. That's one. As far as the pharma space is concerned, of course, we had a very bumper performance during the last lockdown, the last pandemic that we saw in the month of March, April, May, June, the first quarter of FY21. The base is very, very high. But if you were to normalize things from FY20, the CAGR growth rates in almost all Indian pharmaceutical companies is at double digits. And when I say double digits, could be high double digits, so somewhere between 15 and 20%. Valuations, we have seen a correction in the pharmaceutical space as a whole over the last 6-9 months. Valuations have become extremely reasonable. So the opportunity set in the healthcare, the pharmaceutical space emanates both from the IPM, the Indian pharmaceutical market, where visibility on growth for FY23 is better than FY22. Because now again we are in for a second lockdown, you have API prices going up, the raw material costs are going up. But suffice it to say that the volume growth in the pharma space for visibility for FY23 is very high. And again, out here, whether all of that is captured in valuations, I wouldn't think so. So, one would do well to be basically overweight pharmaceuticals and technology is my understanding.
Okay, fantastic. What about consumer discretionary? Manish, if we take a look at that, and even within that, would you narrow it down further into where you feel growth will play out?
Yeah, sure. Basically, low-ticket consumer discretionary items, whether it comes to consumer durables, room air conditioning or kitchen appliances, because the way lifestyle has changed post-pandemic is somewhat more permanent rather than what it used to be, let's say, 2-3 years ago. I would focus on consumer discretionary names, including automobiles. Of course, you're seeing a strong traction out here. Numbers are not yet coming through because of shortages of anti-lock braking systems, of semiconductors, etc. But there is an inherent latent demand in the system as far as the automobile. That also falls within the consumer discretionary. And on the other hand, things to do with living in the house, working from home, so air conditioners fall into that place, or you could see electrical appliances fall into that space, or kitchen appliances, small appliances. This is one space which looks very exciting, both from a penetration point of view, the latent demand in the system point of view, PLI point of view, margins point of view. So that looks good.
Manish, one simple question which in a sense is puzzling everyone is that where is demand getting generated from? Last year the stimulus on interest rates, liquidity boosters, they helped us. But how will this demand keep on generating when we know that the second wave is there, economic impact will be there, job losses will happen? So what is the construct for staying positive?
So first of all, you have ample liquidity coming at lower rates. Interest rates in the system have gone down by 1%. That's one. Government is giving a helping hand to anybody and everybody who wants to borrow at these rates and go on about their businesses. That's one. Government is spending more than what it is earning. FRBM Act has gone out of the window. 3.3%, I mean, we are nowhere close to 3.3%. I mean, we are in almost like 9%, next year around 6%. I mean, these numbers seem to suggest that government is in a way, is in a mood to spend. And of course, when government spends, that money moves in the economy. So it could be job creation, it could be income growth. It's a multiplier effect. There's a virtuous cycle that kicks off. That is where the demand is coming from. And thirdly, real GDP growth is real GDP growth. It's national income of the country. Minus 7.8, swinging to 10.5, between 10.5 and 12 in real terms, 14, 15% in nominal terms, will mean that income will get generated at an accelerated pace, than what we have seen over the last 4-5 years. The fourth aspect is tough reforms by the government. We saw India go through a transient phase, 8% GDP falling to 4% and then 2% and then recession, corporate profits to GDP from 6 to 3 to less than 2, 1.5%. All these things mean that, the positive effects of the reforms will start to get felt. It's already starting to get felt. We're seeing the GST numbers go up. Of course, again, that creates a multiplier when government spends those amounts within the economy. So I think we are in for a virtuous cycle of money supply, income generation, jobs growth, which will trickle down into increased demand. Not to say that incentivizing exports will also help, and government is also again doing all it can in making PLI very popular. That itself also will have a rub-off impact on income generation and demand growth within the economy.
Manish, you said you like autos, but if I look at the numbers which have come for the two-wheeler industry, I've just got an email saying that how the registrations for the month of March have also fallen. Have two-wheelers already peaked out? I mean, four-wheelers is a different kettle of fish, we'll talk about it, but specifically on two-wheelers.
Yeah, so I think it's a case of supply constraint, Nikunj. There are not enough anti-lock braking systems. You have heard corporates talk about it. You have heard Eicher talk about it. You have heard Hero MotoCorp talk about it. Bajaj is also talked about it. There is a severe shortage of semiconductors and anti-lock braking systems, specifically anti-lock braking systems for the two-wheeler space. So you're not seeing the numbers come through. But does that mean that the demand has waned off? I really don't think so. Once this whole thing normalizes within a couple of months or 3 to 4 months, you're again going to see the numbers inch back to what the estimated numbers would be like, and that would resemble decent growth, I would believe. So these are one-offs, I would reckon, rather than being the normal. Of course, we really got to see whether these one-offs really become the new normal. I mean, that's not the base case assumption as of now.
Manish, forget 6 months ago. 6 weeks ago, the market narrative was that India has done much better on COVID and time to look at industrials and cyclicals, something which we just referred to. Now the narrative is that India has seen highest number of single day cases ever and US has seen the highest number of vaccination ever. It's a completely opposite data point versus what we saw 6-8 weeks ago. What does that mean for portfolio investors? Do you think portfolio investors who've been overweight India, who've pumped a lot of liquidity into India, they may be tempted to look back at things, purely looking at how the news has moved on the virus front?
Nikunj, I think the key risk factors over the last 1 year has always been the rise in COVID cases again, that is the second wave. And the second factor was sharp increase in bond yields in India and globally. So these were clearly the two risk factors. Of course, we are seeing a second wave come through in India, but I really don't think that the situation is the same as the last round when we saw this sort of increase. Yeah. Of course, we have crossed all of that. I think the mortality rates are still within control. Of course, the number of cases have been more asymptomatic, but there is hope. There is vaccination that is happening at full swing. And, the situation is not as dire as it was, let's say, the last lockdown. A known unknown is always a better situation to be in as far as portfolio investors are concerned than a unknown unknown. So I think you will see the markets, even global markets, move between risk on and risk off, because one has to live with this COVID-19 issue for a long time now. And even into the future, we'll have to deal with the COVID situation on an ongoing basis. So gyrating between a risk on and a risk off on an ongoing basis, the direction with the vaccination and with the government support and help is clearly favoring a recovery. And more so the industrial space, because we have seen a very lackluster capital formation over the last decade or so. Now, what are the ingredients required for industrial revival? First is the profitability. Of course, due to cost cutting and the demand generation, operating leverage, profitability is definitely on the up. Second is the low interest rate regime that you can put in capex at lower cost. That's one. Third is capacity utilization, which again is very decent. And once capacity moves beyond 75%, of course, there is a case to put in capex. I think all of that is clearly now on the table. And the fourth is the willingness of the government to push the pedal hard when it comes to government playing its part on its balance sheet, use its balance sheet to trigger a private capex recovery. So all of these things, I think, would be reckoned by portfolio investors, where the opportunity set to my mind today is much better than in terms of visibility than what it was, let's say, 12 to 24 months ago.